Welcome back, accounting boffins. Yes, we involved with adjustments and we're getting to grips with the adjustments. Let's look at the next one. What is required of us here? We are told included in the vehicles count is an amount of 950,000 Rand for a delivery van which was purchased on the 1st of December 2019. Vehicles are depreciated at 20% per annum on cost. Right. In terms of my calculation, step number one, find your vehicles figure. As you can see, let's pick it up from here. Vehicles, 1,520,000. Okay, so there's my vehicles figure, 1,520,000. Step number one, start with the opening balance minus the new vehicle. Reason we're subtracting it, included in the vehicles account is the 950 for the new vehicle. Therefore, minus your 950 will give you a figure of 570,000. So obviously, your old vehicles are valued at 570,000. How are we depreciating? We are depreciating on cost. So I know it's just the one figure that I need, namely the 570,000 times the 20%. Let's do that calculation. So we get our depreciation figure, 570,000, which is my old vehicles, times the 20%, because it's 20%, that's your amount. The 570,000 is your amount. Your rate is 20%, times 12, divide by 12, that's a time, and that will give you a figure of 114,000 Rand. Okay, so that's my depreciation on my old vehicle. Let's do the new vehicle. We purchased the new one for 950,000, so immediately we say fine. Let's take the new vehicle now, 950, 1, 2, 3, times 20%, which is my rate of depreciation, times 3 divided by 12. And that gave me a figure of 47,500. Why times 3 divided by 12? This vehicle was purchased when? On the 1st of December. So it was used for December, January, and February. That's where we're getting the 3 months from. So in my calculation, times 3 divided by 12 gave me 47,500. So there's my total depreciation on my vehicles. Okay, so if we take those two figures now, and obviously let's edit, it's the 47,500 plus the 114,000, that will give me 161,500. What is the 161,500? That is the total depreciation on my vehicles. Right, what is it that we have to remember? When you're doing a calculation on depreciation, separate the old from the new. The next question that you ask yourself, is the new vehicle part of my opening balance or not? If it's included, separate it. If it's, or deduct it rather. If it's not included, keep it as two separate calculations. But in any case, keep the calculation separate into old and new. However, the old, the challenge there is the new vehicle part of it or not? If it's not part of it, straightforward. If it is, first remove it, then do your calculation. Okay, next one. On the 31st of August 2019, a computer was taken over by Paul Kluwer, one of the directors for personal use, for 8,000 Rand cash. The relevant page from the fixed assets register is provided below. No entries have been made in respect of the disposal of this asset. Equipment is depreciated at 20% per annum on the diminishing balance method. Immediately I know carrying value, why diminishing balance method? Right, let's look at the calculation. So here's the fixed asset register. Clearly I can see the cost price of the asset was 30,000 Rand, right? What was its accumulated depreciation? The accumulated depreciation before the current year was 13,680. Okay? So now, what am I going to do? Step number one, go and identify your equipment account, which has a balance of 660,000. There we go. So let's do this. The equipment in red, 660,000 is my opening balance. So therefore, I start off by saying 660,000, there's my equipment. Again, just to verify, there's the figure. What was the accumulated depreciation? 484,500. So what are we doing here now? We're saying that, let's just get this figure correct here. Accumulated depreciation on vehicles. The 484 was the vehicles figure. That's not the one that we want. We want the 178,000. Therefore, let's just make this change here. This is incorrect. That's supposed to be 178,000. Clearly you can see there's the 178,000 in my bracket. So because it's diminishing balance, I need two brackets. Step number one, first 660 from my given information. Step number two, the accumulated actually this should say not that is why it's the vehicles amount, that should be equipment. So we've corrected that now. There's my equipment, accumulated depreciation on equipment is 178,000. There's my 178,000. Right. Now, the asset that I'm disposing of, the equipment, had a cost price of 30,000. Here we go. There's the 30,000. So, in my calculation, minus the 30,000. The accumulated on this computer was how much? There we go. 13,680. Therefore, minus 13,680. So, let's take our figures. So, step number one, we go 660,000 minus the 30,000, and that will give you a figure of 630,000. Okay, so that figure there, the net effect of that is 630,000 minus, if you look at the other one now, your 178,000 was the opening balance, 178,000 minus 13,680, and the figure there is 164,320. 164,320. So what do we do now? Now we take our 630,000 minus the 164,320 to give you a figure of 456,680, and then our rate of depreciation we knew, did they tell us, was 20%. Okay, so here we go. Let's do that there in our calculation times the 20%, and this will give you a figure of 93,136. There we have it. Our accumulated or the entry for the depreciation on the old equipment. Okay, now, what is important here? You had to separate the asset that you disposed of. You had to remove it from your calculation. Why were we using two brackets? Because it was the diminishing balance method. So you've got cost price minus accumulated depreciation. Important, remove the cost price, remove the accumulated depreciation. But remember, when you're removing the accumulated depreciation, it's your balance at the beginning of the financial year, not the total accumulated on that asset that you are disposing of, but rather the balance at the beginning of the year. Okay, the next thing that we do now is we look at the asset disposal. Once again, there's my cost price of 30,000. There's my accumulated depreciation opening balance, right? If you work out your current depreciation, what do we do? Let's do the calculation together so you can see what we're saying. It's your cost price of 30,000. There we go. The cost price of 30,000, right? Minus your, we need the other slide. Let's go back. That's the one, right? So here we go. Minus your accumulated of 13,000. Let's start all over again. Delete. 30,000 minus 13,680, which was my accumulated depreciation, gave me that figure, right? Times 6 divided by 12, and that gave me a figure of, let's redo the calculation. So we got 30,000 minus 13,680, gave me that figure there, times the 20%, okay, gave you that. times 6 divided by 12. And that gave me a figure of 1632. What was the 1632? That was my current year's depreciation. Add it to my accumulated to give me a total accumulated of 15,312, right? Now you subtract 30,000. Let's take the 30,000, which was my cost price, minus my accumulated of 15,312 to give me a figure of 14,688. There's my carrying value. I sold it for 8,000 Rand. Clearly you can see that your selling price is less than your carrying value, indicating you've made a loss. A loss of how much? 6688 in this case here. Right. Now what do we do? In terms of my depreciation, I take the 114,000 Rand, which I calculated already, plus the 47.5, plus the 1632, plus the 93,136 to give me total depreciation of 256,268. Let's identify those amounts. There we go. 114,000 was the vehicle's old. The vehicle's new was 47.5. Let's see if we have them there. 114 plus the 47.5. Remember, on your sold equipment, namely the computer, was 1632. And then we also worked out the other one, the equipment on the old equipment, the 93,136. And that gave me the 93,136. My total depreciation was 256,268. So, for my statement of comprehensive income, I need my total depreciation. In this case here, it was the old vehicle plus the new vehicle, the sold equipment, namely the computer, plus the unsold equipment, total depreciation figure. And now, the next thing that we do is we look at our format of our income statement. What do we have? We have our commission income. We've adjusted our rent income. We had our provision for bad debt adjustment as an income that gave you gross operating profit. Okay, then you took the operating expenses, salaries and wages, insurance, bad debts. Now all of these, we did the adjustments. There's the calculation. There's your loss on theft. There's your adjustment. Remember the loss on sale of asset as well. We've done the adjustment. Here's your trading stock deficit. We've done the adjustment as well. And obviously the depreciation, we've shown you the calculation. Because you've done the calculation prior to it, if this would actually feature in your statement of comprehensive income as your calculation shows here, depreciation 256,268. You've got your operating profit. You've add your interest income. You bring it, that will be your operating profit before interest expense. You've got the interest expense, that one also we've calculated to give us a net profit for the year of 2,720,000. Okay guys, that was now how you use your adjustments to complete your statement of comprehensive income. What is most important is to take every adjustment and show its effect on the statement of comprehensive income. In other words, show your calculations. And once you do that, obviously, you then complete the statement of comprehensive income. Once again, a recap. Which are the adjustments that you're looking for? Accrued income plus deferred income minus. What am I referring to? The operation in the bracket. Accrued expenses plus prepaid expenses minus operation in the bracket. Consumable stores on hand minus operation in the bracket. With consumable stores on hand, be careful. Are they giving you the amount that you've used or the amount that is left over? This particular example did not have anything on consumable stores on hand, but what you're going to do now is get your hands on as many income statements as you can, look at past papers, work through your questions, and as you'll notice that when you walk into an exam room, you have to walk into an exam room with BMT. BMT. What is BMT, guys? Big match temperament. By that we mean, if you practice adequately, your confidence is at a high, and definitely you will have BMT when you walk into an exam room. Ace that accounting exam, because Ashraf and the crew have worked very hard for you to ensure that you will always be an accounting shining star. Until next time, be good. Goodbye.